So this may well be the last of our series in tracking the Iran war, if peace holds, that is.
If. That's a big if, Matthew.
Yes, that's right. And over the weekend, at least on a positive front, we saw the US and Iran agreeing, yet again, I might say, to drop the tit for tat attacks on one another that's plagued the situation over the last couple of weeks or so. And the good news is markets have been responding well to the situation, actually.
Yeah, they sure have, Matt. We've been using the market pricing along with our benign, malign, and malignant scenarios to track where we think we are in the Iran war. And I guess the key really is the oil price, and it's fallen pretty sharply over the last couple of weeks. Currently, it's around about $72 a barrel for Brent crude, down from a peak of around 125. So big falls there, but it's still above the sort of $60 to $65 a barrel it was before any threat of war started to appear in the market prices. So our benign scenario had the 30 June deadline for the resolution, and with prices heading lower over the second half of the year, which they've clearly done, it looks like we are in that benign scenario. And I guess if anything, the prices might have even fallen a little bit faster than we thought. So Matt, is this the end? Can we declare the war over?
Well, as much as I'd like to, and as much as I'd like to say this is definitively the last in the series of our tracking the Iran war, I don't think we can make that step just at the moment. There's only a memorandum of understanding for 60 days where they negotiate the final peace agreement. And there's really two key sticking points at this stage. The first is Iran's insistence, it seems, to charge a toll for transiting the Strait of Hormuz, and whether the Trump administration can take that step to agree to that, given the situation in domestic politics where there's quite a bit of backlash against making too many concessions to Iran. Whether the Trump administration can agree to that is a question mark. And the second is Iran's insistence that Israel stop attacking Lebanon. Now, flare-ups in the near term seem to be focused in these two areas, but clearly the US has really little appetite for re-escalating the war. So hopefully those two sticking points will be resolved. In the longer term, there's also Iran's nuclear program is likely to remain an unresolved issue. So whilst in the short run they might agree to some accommodation over the nuclear program, it's going to, unless Iran agrees definitively over the longer term to renounce its ambition to generate or create nuclear weapons, I think that's going to be an unresolved issue as well.
So good news, but the risks remain both in the short term and it sounds like beyond the short term as well, Matt, into the longer term.
Yeah, I think that's right, Linda. Those risks, as you say, are here to stay. And in fact, you can see it priced into markets at the moment, particularly the oil market, where the futures market is flat at about $70 a barrel, rather than heading back down to that 60-ish dollar a barrel level that they were prior to the war. We interpret that as the Middle East premium now in this new world where the Gulf is no longer a stable source of oil. So while the truce means we've dodged the global recessionary bullet for the time being, we've still suffered 3.5 months of high oil prices, which is having economic impacts. So Linda, we just got the May inflation numbers out last week in Australia, and ironically, we saw the price of petrol fall for the second consecutive month, and that's due to the cut in the fuel excise tax. But what we are more concerned about was the pass through to other sectors of the economy from the oil shock. So I know you've been looking with your team at the data, scrutinising it deeply and on a regular basis. So can you share with us what the data is telling you about the pass through of the higher oil prices?
Yeah, well, you do have the good news coming through with the petrol prices now falling. They peaked in March and have fallen in both April and May. And that's seen the headline inflation rate fall from a peak of 4.6% down to 4%. So that's good news. And it's likely that we have already seen the peak in headline inflation. As you say, the thing we've been more worried about is ongoing pass-through. Now, the complication of that is that we will be still seeing pass-through from the higher prices that we saw in March, through to the cost base of the economy, and initially through sort of transport costs, but then into your grocery prices as fertilizer costs have been passed through, and construction costs as your petrochemical prices have been passed through. But also with those, what we're likely to see is that they peak and then come back down in line with what's happened in the energy markets. So part of the reason for calling the benign scenario benign is that the full increase in prices never actually made it through the economy. And that's sort of what we're starting to see now. And you're actually starting to see bits of it in the data. So if we looked at, for example, the first part of the pass through was through your delivery costs, like your Australia Post delivery costs. Those prices rose by about 10% over March and April, but they've actually started to fall back a bit now that the fuel prices come down. Similarly, we've started to see construction costs rise quite sharply. They're up 0.9% in the month of May. And we're likely to see a bit more being passed through. But again, some of those petrochemical prices that had really risen sharply have started to unwind as the war has progressed and started to come to an end.
And obviously we see that, as you say, start to ease construction costs, which also have the pressure coming from high unit labour costs too, don't they?
They do, but I think that's probably a story outside the scope of the Iran war. That's like an ongoing place that the Australian economy will come back to, is the elevated unit labour costs that, the RBA was tightening policy into the start of the Iran war. And you're going to see this pass-through come through as a result of the Iran war. You've already seen it in the headline. It's starting to come back now. You're likely to see it for a bit longer in your underlying inflation measures through the construction costs and through the groceries. It will start to mitigate then too. What we're left with then is a situation where, the RBA has to face the domestic underlying cost pressures and work out whether they've taken policy into a restrictive enough place to be able to bring inflation back to target within a timely horizon.
Yeah, so we've dodged a bullet or the RBA, I should say, has dodged a bullet in the sense that had there been ongoing pass-through from the oil prices, they would have had to have raised interest rates given the underlying pressure that was coming from the labour market, from high unit labour costs. But now they potentially can get away with sitting on the cash rate at 4.35% rather than having to raise rates, depending on what happens now to domestic costs.
That's right. And there, you would expect to see that the impact of the Iran war and rate hikes will be starting to sort of dampen the economy as we go over the course of this year. And that should reduce some capacity pressures in the economy. Whether that happens quickly enough for the RBA to stay on the sidelines, or whether the RBA decides they need to do a little bit more, I guess is what we wait to see for the second half of the year. And our view on that is that they can sit tight for a little bit longer.
This was the point of the benign scenario, that the external cost pressures coming from abroad, in this case the oil price, don't put further upward pressure on inflation. The RBA stays at 4.35% and the economy slows, and they are able to then lower rates perhaps at the start of next year. The alternative is if you've got all this pass-through, the pressure on domestic inflation would have caused them to raise rates higher because they'd have to snuff out more of the domestic demand. They'd have to weaken the domestic economy even further by taking rates higher in order to alleviate inflation pressure. So again, potentially, just like the rest of the world, we've dodged what may have been a recessionary bullet.